Hello everyone, and thank you for joining us this afternoon for the Strix Group's interim results. We are joined by Mark Bartlett, CEO, and Raudres Wong, CFO, who are here to talk you through both the numbers and the acquisition which they announced this morning. We are recording this, so it'll also be available to watch back later. We will be taking questions at the end, so please submit them as we go along, and then we will put them to management. Without further ado, I will hand over to Mark Bartlett.
Good afternoon, and thank you very much, Hannah. So this is a bit of a new experience for me, not being able to see anybody there. First of all, welcome to everybody. Unfortunately, we can't meet face to face, so it's yet another Zoom presentation. But I really hope that in the next sort of 30 to 40 minutes, we can provide you with a detailed update on Strix. And I'm hoping it'll be far more upbeat than most of the messages and communications we're hearing these days. As you will see from the pack we're going to go through, we have been very busy. So let me start with some highlights shown on slide 3. For Strix, this has been another solid performance, very much in line with our expectations and our scenario planning, given the current climate. First half, obviously impacted very much by the various lockdowns and all the supply issues in China. Going through this presentation, Raudres will cover the H1 numbers shortly, but I'm pleased to say we've started to see a positive recovery in June, as we had originally anticipated. A record Q3 for the company is what we forecast at the moment. And we still project full year profit to be flat versus prior year, which I think under the circumstances is a very good performance. We did implement some cost efficiency measures very swiftly at the start of this pandemic to manage our balance sheet, and we will continue to do that as appropriate, should any further disruptions continue. The factory in China remains very much on budget and on track to be fully operational by August 2021, which is in line with our original schedule. And we have actually now gone live with our new ERP system, so we're keeping very busy during this period of time. We did manage to secure some additional financing during H1, giving us improved headroom. So we ended up with 23 million liquidity at the end of H1 with the same favourable terms. And I'm pleased to confirm, based on the current trading, we remain committed to delivering that full year dividend of 7.7 pence in line with our 2019 payment. As many of you will have seen, we were burning our midnight oil last night and have also now entered into a conditional agreement to acquire an Italian-based company called Laica, which is subject to final consent from the Council of Ministers in Italy because they do have some COVID-related products. This is a really significant opportunity for Strix and will greatly enhance our position both within the water filtration but also in the small domestic appliance categories as well. And there is a process we have to go through to reach completion of that particular acquisition, and we expect to receive confirmation for that completion, certainly within the next 65 days, so certainly within December of this year. So if we can move on to slide 4, you sort of can't get away these days of having a presentation without at least some talk about COVID, so let's get it out of the way early on. You may remember we were very, very proactive in the early days, finding solutions to minimize the downtime in China. And actually, we only had just 1 week of additional shutdowns over in China due to the work that we conducted. We continue to take a very proactive role across all of our sites to ensure minimal disruption, with efficiency measures taken that have delivered in excess of £3 million during the first half of the year. We obviously continue to manage our balance sheet very carefully. We also worked very closely with local governments, particularly here on the island, providing a wide range of services that included everything from the development of specialised valves for breathing equipment, sourcing and testing PPE through our global supply chain, particularly over in China, as well as setting up a production line for manufacture of key items such as visors used in our local hospital here on the island. I mean, there is no question, and I'm sure all of those sitting in the UK will understand this, that we are in a very fortunate position here on the island. We had very, very strong support from local government, and we've been able to keep our facilities operational throughout the pandemic. We must be one of the only places left on the planet, I think, that does not require any social distancing and where everything is actually fully open, except we don't allow visitors to the island. Providing a safe place to work has been obviously a key priority for our business, really focusing on the health and well-being of all of our staff globally. And we have implemented a number of initiatives over and above the statutory requirements to maintain a safe working environment. From a business perspective, we have carefully managed our cash. We secured key commodities for the year, whilst continuing to invest in key strategic initiatives with measures in place to ensure we minimise any downtime should the situation worsen. And with that very quick overview, I'm going to pass over to Raudres to look at the financials, if I may.
Right. Thank you, Mark. Good afternoon, everybody. Let's turn to slide 6, where we're going to see some financial highlights. So revenue has declined 21% in the first half, reported at 34.7 million, which is in line with our expectations under the pandemic disruptions. It was the same level on a constant currency basis. Absolute gross profit growth was circa 18% down, reflecting the trading downfall. Gross profit margin, however, increased by 1.7 points to 39.7%, reflecting the robustness in our business model, where we managed to flex the variable and semi-variable costs to align to the trading forecast. Important point to note is that with lower demand, we did not run the manual lines, production lines that would have yielded lower unit profit. We let run all the fully automated lines to allow our margin to go higher. So obviously the fully automation lines give higher profit, and it is certainly in our strategy plan to continue to automate our production. Adjusted EBITDA reduced by 8.6%, reported at 13.6 million, which appeared to be a similar number as the gross profit. It was a result of our concerted efforts to streamline operating costs along with our restructuring measures, which benefited Q2 and will continue to benefit the full year. Reported EBITDA was slightly ahead of last year as share-based payment cost was reduced by 2 million, with the IPO batch of LTIPs fully expensed up to the end of last year. Adjusted profit before tax reported 12.5% decrease at 10.1 million is mainly impacted by the higher IFRS 16 depreciation cost, where now the Halo source is fully on board. Net debt increased to 36.9 million from year end, but we initially had 6 million higher in the budget plan. Obviously, the cash preservation efforts were successful, where CapEx projects were rephased without disruption to our automation plan, nor to our new factory completion date. Our supply chain was tightened up to the just-in-time concept to lower our working capital, where it was managed to levels at a similar level as last year interims. Dividends, the board proposed to pay 2.6p as interim dividends, given our strong cash generation ability despite of the macro disruptions. If we can turn to slide 7 with more highlights on the P&L. So revenue was decreased in line with our expectation. In terms of the category, the water category fared modestly better by 2% increase. The appliance category was flat. Kettle control was the main shortfall that caused a 24% shortfall. Our operating cost below the gross margin line was reduced by 27%, circa 1.3 million. It's due to our scrutiny to streamline the non-critical overhead spending, such as marketing spend, travelings, along with lower carriage costs, salary freeze, and reorganization costs. Exceptional cost for first half was 2.5 million, mainly consists of share-based payment costs of 1 million, strategic project cost of 700K. Again, the share-based payment costs come down substantially from last year of 3 million in the first half. Adjusted PAT was helped by savings in China taxes, and hence the decline magnitude was lower than the adjusted PBT. Our tax model for China has changed to an import processing license in 2019 as a better tax scheme. And for full year guidance, we estimated the current year to be 4% as the effective tax rate, but that was before the Laica. So for next year, the Laica as a group rate will increase to 6%. Our Alaman operation remained at 0% corporate tax rate. So next slide, we can turn to page 9. Some highlight on the net debt, which is now in the consolidated view, inclusive of the Laica acquisition. The upper section here of this slide contains 2 bars. The first bar shows the predicted position of the group with Laica acquisition at year end. The second bar shows our first half results. The group FD, the group FY20 projected our net debt to year end inclusive of Laica, and the earn-out consideration is projected to be 53 million. This will drive up our net debt EBITDA multiple to 1.4 times from our interims of 1.1 times. Though I have to refresh you all that at IPO times in 2017, our net debt multiple was at 1.7 times. If we exclude the earn-out considerations, the net debt multiples will be 1.2 times at year end. We forecast the net debt multiple will deleverage by FY21 year end to 1.2 times. However, if we exclude the earn-out considerations, the net debt multiple will deleverage to 1 time multiple. Our RCF is secure to increase to 80 million by adding a third bank, which is the Bank of Ireland, along with the 2 other banks, NatWest and Bank of China, with the favorable terms remain unchanged for 5 years. RCF headroom now will increase substantially by 26 million, with our liquidity pool projected to increase to circa 33 million. If we can turn to slide 10, this is a very special slide that provides projection to the full year adjusted PBT. Now, we don't usually provide explicit forecasts, but given the uncertainties in the macro environment, we thought that it would be helpful to our investors with a slide of a projection to better understand the underlying strength of our business. The first 2 columns are the first half results, where trading losses was largely helped by our cost savings initiatives. For the second half, as per what we have announced in pre-closing, we have projected a rebound based on our past experience on the various crises. And I'm happy to say that recovery has started in Q3, and that in fact, the whole Q3 profit forecast was secure. So it will result in a record high quarter. To secure the full year target, our Q4 target needs not be as high as the previous Q4, as Q4 usually is the largest quarter of the year. As for our overhead spending forecast, however, we do need to invest a bit more in second half versus last year, last year's second half, in order to support the trading growth in the second half altogether. So that hopefully help to explain our confidence in achieving the full year profitability in line with the previous year. Onto slide 11, more positive update about our factory constructions. All the milestones of our factory construction were on track despite of a delayed start in February this year. There was no impact to the target completion date, nor was there any impact to the construction budget. The building construction was completed in July. Second half is to focus on the inner renovation work and all the electronics installation. The target remains to complete and ready for moving in next January, where a transition plan is to take place over 6 months between January to July. We will build up stocks in order to buffer any shocks, but there will be no impact to working capital as any new stocks built up will be burnt by year end. And there is no requirement to pay any redundancies to relocate the staff and factory labor. However, we will implement a financial support plan and incentives plan to ensure that all the staff are supported to move to the new location. Our CapEx budget for the factory remain unchanged at 20 million, with 3 million negotiated to move out from the current year to FY21. So with this, I'm going to stop for the time being, and I'll like to pass back to Mark for further business updates.
Thank you very much, Raudres. So I'd like to look at the investment proposition on slide 12. So despite all of the uncertainty and disruption in the market, we have a very resilient business model, and we continue to invest to realise our growth potential. First of all, looking at CapEx, it's £7 million operational investment with 3 new automated lines added in the first half of the year and a further 2 going in the second half of the year. By the end of this year, we will have 60% of our production lines automated over in China. Obviously, there's the investment in the construction of our new factory, which Raudres has already mentioned. That will double our capacity and certainly improve our efficiency. And we're looking to have a formal opening of that factory in October next year, assuming we can all travel, of course, by then. From an acquisition point of view, as you've heard, we've acquired Laica. We will talk about that in a bit more detail in a minute, but that really is a perfect fit to expand both our water and our small domestic supply categories. You may remember in the past, we've always talked about the growth of the business being in those other segments. To date, 90% of our revenues have been in Kettles, and we really are looking to grow those 2 sectors. And as you'll see, Laica really does offer us a really good opportunity to drive that growth and accelerate that growth going forward. From a dividend point of view, given H1 performance and given the record Q3 and the order book that we're currently holding, coupled with the board's confidence in our cash generation, we have confirmed an interim dividend to 2.6 pence with a commitment to deliver the full year dividend of 7.7 pence, which is in line with the prior year. From a balance sheet perspective, balance sheet with net debt to EBITDA ratio well below covenant levels at 1.1 times. We've also completed successfully the refinancing, bringing Bank of China in, providing headroom of 23 million at the end of H1. So if I can move on to slide 13 and look at the sustainability aspects of our business. Within our product range, we have many products that fit with the ESG megatrends. These provide a range of benefits, significant energy saving, eliminating the need for single-use plastics, as well as providing safe drinking water through the removal of viruses and bacteria. This focus is absolutely key on our product roadmap, but in addition, we're also looking at our own business to see what else we can do to improve our sustainability footprint. So just looking at some of these key elements, energy efficiency to start with, we have put in significant amount of automation, which has improved our efficiency. We're looking to recover and reuse the water being used in our test systems. Obviously, testing kettles, you do go through quite a lot of boiled water, and we can use that in a variety of different ways. We also have accreditation to ISO 5001 to support our energy efficiency claims. From an emissions point of view, we're working to source renewable power and really review our business travel in what is now deemed the new normal. Certainly, my travel this year has dropped significantly, and I'm sure, as with many businesses, this is going to be quite a permanent change, using media like this to be able to communicate much more regularly. From a resource point of view, we already actually recycle 97% of our waste within our operations with zero landfill, and we're accredited to ISO 14001. Obviously, we will continue to review our supply chain globally and really push this responsibility onto our suppliers, particularly over in China. As mentioned, with water use, we are working to reduce the amount of water we consume, particularly during cleaning and testing of our products, using different technologies and new technologies, as well as new processes within our operations. And then from a diversity point of view, a very strong position. We have good gender diversity of actually 49% globally, and we continue to focus on areas such as our management levels, which are certainly at a lower percentage, and actively promote diversity across our business. And then from a health and wellness point of view, obviously this is a key focus under the current environment, protecting our employees, but we are also focused on eliminating unsafe products from the market by doing all the tests we do on unregulated products or copyist products, and also providing safe drinking water globally. So we are working hard on our sustainability footprint, and we are intending to have a Capital Markets Day in November where we will provide a much more detailed update on our progress in this particular area. So if I can move on to slide 15, we will start to look at the various categories within our business, obviously starting with the kettle controls, which is our core business. As you can see in the first half, sales were actually soft, which is not really surprising given all the various lockdowns around the world and we reacted very swiftly to manage our variable costs, as Raudres has already explained. We managed to maintain a stable value share across the global market and really continue to focus on our value-added services, supporting OEMs, brands, and retailers around the world. As mentioned, Q3, we have seen a very, very positive bounce back, which was, as we anticipated, recording record sales, which are likely to be 26% above prior year. We've actually seen a very, very strong recovery, particularly in the regulated side of the market. And that's a combination of the pipeline being refilled and also the seasonality. The second half of the year is always higher sales, with some of the promotions also being moved into Q4. Also, we've seen a very significant growth in online sales, as you would expect. And we've managed to take advantage of those through different territories. Within this particular sector, we have launched 5 new controls, which really give us more access to the lower end markets and give us a more competitive position, so we compete more aggressively with all of our competitors within the market. So moving to slide 16 and just looking at the roadmap within that, you can see we are going to continue to expand the U9 products. Already we've sold 7 million of those controls. We're looking to expand the electronic category, which is actually growing very well, particularly in the China market. And we're also going to introduce some washproof applications for some slightly more diverse product sets. Moving to slide 17, just moving into the water category. Again, the water business actually has performed very well during the disruptions, posting a growth of around 2% even during the first half of the year. In particular, we launched the Lumi product, which is our first own brand appliance for Aqua Optima, and that has been really successful with growth well above 1,000%, albeit from a low base. And we have also invested in category management to make sure we are really focused on the consumer needs and finding the appropriate products and the right pricing for those products. Again, a very, very strong growth in the online sales, as you may expect, and Q3 forecasted at 28% growth over the prior year as we expand our distribution network further outside of the UK. With the new product side, again, we have some strong success. We will have 6 new products ready to launch in 2020, which will include a new water purification system for chickens. Never thought I'd be talking about chickens in a meeting like this, but this has been a very, very interesting application that we'll talk about, primarily in China. And this is a significant opportunity in the future using our Halo Pure technology. If we move on to the roadmap on slide 18, in 2020, you will see the launch of the new Aurora product, a really interesting product which will provide chilled, variable temperature and true boiled water. I say that very carefully because our heater system is patented to ensure that you do get actual boiled water from the system. This is a standalone unit, similar to a coffee machine, that will provide you a range of different types of water for your family's needs. Also, that will also include a filtration inside there, so we're actually getting the on sales of the filters as well. Moving into slide 19, looking at the SDA category, this is actually the smallest category of the 3 at the moment, but it's still shown a very strong Q2. And once again, we are looking at record sales in Q3, which will offset the shortfall that was there in Q1. We're seeing significant interest in the hot water on demand applications in particular, and we'll have 4 new products ready to launch this year. And again, if we can move over to slide 20 to look at that roadmap, we can show you some of those products. First of all, a move into garment care with a very robust control for use with cordless steam irons. Obviously, they get a lot of abuse being thrown on and off the stands, so our controls are actually quite unique, very robust, and can survive up to 100,000 cycles. The duality product you can see there on the second picture, some of you may have seen and may remember from previous conversations, and that is in the OEM tooling at the moment and will be launched with a US partner shortly. Certainly initially in the US and then obviously later going into next year in Europe and elsewhere. But this actual product gives you the ability to save a significant amount of energy just boiling the amount of water you need for a single cup, or giving you the opportunity to boil the whole kettle if you prefer. We've also launched a new baby prep system with Tommy Tippy. I'm sure you remember we have a very, very strong partnership with Tommy Tippy, This new range of products is an extension of the existing range to allow us to move into other countries across Europe, and will obviously open up new markets. And then, of course, we've also got the Aurora that I've mentioned previously. We haven't finished, and we still have some things coming soon. Some of you may remember we talked about an induction kettle. Certainly that's something we are working on at the moment, and that's a watch this space looking into next year, where we will actually start to bring in into the market a very unique induction kettle, which will actually have some quite disruptive technology within it. So if I may move on to slide 22 and look at the business outlook. Clearly, there remains a lot of opportunity around, but I believe that we are very well placed given our current position. From a growth perspective, we will maintain our value share. We are going to deliver on our NPD commitments, strengthening the Strix brand and diversifying our revenue base across all the three categories. Obviously, now supported by the acquisition of Laica. In the operations part of our business, we're going to continue strategic investment in our operations, continuing to focus on automation, improving efficiency in the factory, obviously building the new factory over in China, and really putting our focus on our cost base with lean and continuous improvement initiatives. Your people clearly are very important in our business, and to be fair, our people have been exceptional throughout this unprecedented period getting us through, and we will continue to invest in key talent to support our growth plans and to ensure a safe environment to work for all of our employees. And then finally, from a shareholder value point of view, as mentioned previously, we have declared the interim dividend, and we are fully committed to the full year dividend of 7.7 pence, in line with our previous policy. We've managed our balance sheet prudently, investing in key initiatives to support business growth, whilst implementing appropriate efficiency measures to ensure we can preserve cash, something we will continue to do during these times of uncertainty. So with that, I would like to pass over to Raudres to give you a bit of an insight over the recent acquisition that was actually notified overnight.
Thanks, Mark. So if we can turn to page 24, where it highlights summary of Laica. So we're very excited about Laica, as it is a major milestone to fulfill our strategy and enhance our shareholders' value. Laica was established for over 40 years. It is an Italian company focused on water purification and small household appliances for personal health and wellness. It is headquartered in Vicenza in Italy. It has a state-of-the-art production line for its water filtration product, and also it has added facility in China through their joint venture partnership. The company is jointly owned by the Moritos family, where it's the brother and sister relationship. It is a company of 53 staff, inclusive of manufacturing labor. It generated top line of 20 million euro in FY19 with an EBITDA margin of 14%. We would expect similar results in the current year, given its resilient business model, and also its health-related products is continuing strong demands under the pandemic environment. As Laica was owners managed, they have not really paid attention to the supply chain management, so it was rather weak. It has quite a high working capital, averaging to between 6 to 8 million euro at year end. We're comparing to Strix of roughly about 1 million a year end historically. That is quite excessive. So there is absolutely a lot of room for us to improve once we take control of the company. So if we can turn to slide 25, more about the Laica transaction overview. The initial consideration is for 19.6 million euro, which is about 6.8 times on adjusted EBITDA on completion. Full consideration is 31.6 million, including the earnouts, and that will work out to be 10.9 times multiple. Initial consideration, which is going to be payable on completion, will be funded in 11.6 million cash by extending our RCF and 8 million in Strix equity. Deferred consideration of 12 million euro will be payable in cash in the next 2 years, subject to performance and employment conditions. For employment conditions, the Laica owner, and who is the CEO and founder, has to remain in business for the following two and a half years in FY21 and FY22, where the deferred consideration is for 2 million and 2.9 million respectively. For performance conditions, Laica has to deliver performance targets. To qualify for the earnouts, the deferred consideration is up to 4 million and 3.1 respectively. So all these deferred consideration will kick in if they are fulfilled in FY22 and FY23 respectively. Our consolidated first full year is expected to be accretive of about mid-digit before any synergies to be considered. Net debt on completion is projected at 1.4 times multiple, where we'll deleverage to 1.2 times the multiple to in next year end. And if earnout is not counted as a liability because it's not earned yet, then it would go down to 1 times multiple. The shares issued to fund the acquisition has a lockdown period of 6 months from closing. And the SPA was signed and final completion is subject to the Italian government approval. We expect that to be about 65 days to roughly December. So because of that, we do not expect to include any of the Laica's contribution this year. So can I pass back to Mark now for further update about the transaction rationale?
Great, thanks, Raudres. So just looking at the rationale, as I said earlier, this really is the perfect fit for Strix. Really focusing on those two other growth categories of the water category and the small domestic appliances. It will strengthen Strix's market position within the water category, really trying to provide a global platform to facilitate its growth. It'll be earnings enhancing, and we're expecting with leverage on completion to be around 1.4 times net debt to adjusted EBITDA. The product set and the geographical offerings are both complementary, and we'll look at the products in a few seconds. When you look at the business for Laica, they really are focused significantly on the Italian market. 70% of their sales, in fact, on the Italian market, whereas Aqua Optima is focused very much in the UK, and Australia is focused very much in the USA. So between those three brands, there's the opportunity to be able to cross-sell those products in all those various markets. It also allows some organic growth, bringing new products to market. One of the attractions of the acquisition of Laica is they have a really good new product roadmap. And when we actually went to see this company and we looked at their roadmap, and we compared it with our own, we can actually see a lot of similarities between the two, but this acquisition will certainly accelerate the new product development within Strix for the water segment. They have very, very strong management. The owner, the CEO, who will be with us certainly for the next 2.5 to 3 years, is the visionary of the company, been with the company for over 3 decades and really knows this industry better than anybody. He will stay with the business and help us to actually make sure we can bring his legacy to life. Certainly that's what he's looking for, but also make sure we can realize the synergies between the various companies over the next 1 to 2 years. And certainly this is very much in line with our M&A and our ESG strategy, supporting our medium targets and certainly our growth objectives going forward. If we move to slide 27, you'll sort of see some of the products. Some of these products do sort of overlap with the Aqua Optima, but a lot of the things like the fridge jugs, for instance, Aqua Optima actually buy those in from various suppliers around the world. So clearly an opportunity for us to take some of these products to different places. And they also have this SDA category, which is actually focused at the health and wellness, which fits really well with our small domestic appliance category as well. In the new product side, a number of new things that are working on. We've just shown a few here. One of them is a very small fast flow filter, which will work very well in things like plastic bottles. And you've no need to actually suck through the filter. So it'll just be like drinking out of a bottle. And the flow is very, very fast for those products. But certainly we can see a number of new product ideas coming through from this acquisition. And we will actually then support that with our R&D center over in Seattle that we acquired with the Halo source technology as well. So certainly giving us access to a lot of new products that we can cross-sell across those markets. And then finally, looking at the synergies between the business on slide 28. We tend to be quite conservative, and anybody who's been following us will see that. And actually in the numbers that Raudres has already presented, we do not include any synergies. Clearly there are synergies within this business, and something I'm very keen to actually be able to extract. And we've put them into two categories here. First of all, it's the revenue synergies. As I mentioned, Laica really are selling primarily into Italy. Aqua Optima is selling primarily into the UK. There's an opportunity to cross-sell all of those products and get a good, better, best type portfolio of products between those two different companies. Both of us are starting to be very active in China. And actually, Laica actually has a joint venture with a company called Xingbao, who is actually our largest customer ourselves, and they are the largest manufacturer of small domestic appliances in the world. So that combination of the three parties will allow us some very good mutual opportunities, not just with the water category, in fact, but also with some of our SDA products going forward as well. Looking at some of the cost synergies that we have, they have a very, very strong marketing team. Certainly they use statistics very, very well, looking at Google Analytics, for instance, to make sure that they are targeting the right customers and the right price points. Something certainly we will adopt across the business for Aqua Optima and for the Australia products over in the US as well. From an operations point of view, clearly there is going to be some operational efficiencies. They have a state-of-the-art production site over in Italy. Sorry, my TV was just going to turn off there, apologies. So they have a state-of-the-art production line, fully automated line, very, very similar actually to the ones that we had ourselves over in China. We will obviously keep that running, and obviously it's ideally situated, and it actually gives us a manufacturing site or a manufacturing base in Europe, which clearly is very positive for us as well. However, there are opportunities. For instance, right now we produce some products for America. We actually buy some of that product in Italy. In fact, we ship it to China, we put it together in China, and then we ship it to America, and we pay a tariff as it goes into America. Clearly, with Laica, we will be able to actually make some very significant changes in that supply chain. You're producing it long term in Italy and sending it direct, which will save us something like 20 to 25% in the margin. From an R&D point of view, they have a very, very strong R&D team, as we do in Seattle, and certainly we'll combine those skills to make sure that we can both take cost out of product and continue to actually develop a very proactive roadmap for the future. One of the things that is very strong with Laica, they are considered to be the innovator in this particular field, and certainly we want to maintain that so we can challenge the bigger competitors in the marketplace. And then just generally, there clearly is other options to optimize functions and processes, and certainly we will look to do that as we start to integrate those two businesses together. So a very quick run through of the pack here. Hopefully that gives you an insight. Clearly lots of things going on. We believe some very strong opportunities going forward. And with that, Hannah, I'll pass back to you to field any questions, if I may.
Thank you very much, Mark. Well, we've had a number in. We will try and motor through as many as we can in the time remaining. Let's start with one on the acquisition. Why are they selling, the owners of Laica, and how did you become aware of the opportunity?
Right. We actually received a letter in the post, funnily enough, and they were being a little bit opportunistic, sending out to see what sort of interest they would have in selling the company. We already had been looking at filtration type companies, and they were on our radar, although we weren't actually starting discussions with them. But on the basis of that letter that came through, we did engage with them and really tried to understand the business in a bit more detail. They went through a bidding process at end of last year, obviously we were involved in, and we were actually considered to be the preferred acquirer of that business, not because we were offering the best price, because we certainly weren't, but because they wanted to see the legacy continue, and they believed that we would actually take the business, not as it was, but pretty much as it was, at least keep the manufacturing site in Italy and grow the business. Whereas many of the other people were looking to either move it or literally just to treat it as a sort of private equity deal. The reason that they're actually selling the business, the two owners, brother and sister, are both just over 60. They know that they want to see that legacy go through, particularly the CEO, Maurizio. He wants to see his legacy being delivered, and he knows that he's got 3-5 more years that he wants to be able to work into this industry. So he wanted to sell it so that he can still be part of that going forward. And part of the agreement is that he will stay with the business for the next 3 years. So it worked out really well, I think, for both parties.
I would agree, and you look like good custodians for the business. So does Laica bring its own sort of IP in with it?
Yeah, they actually have quite an extensive range of IP. I think Laica are best described to be quite fast followers. They also are innovators within the market. But yeah, they have taken out a fair number of patents over the years, and obviously we've acquired all those patents. Yeah, and as we do with our own patents, we will defend them very vigorously.
Always been known for that. The Laica gross margins, obviously, it's immediately earnings enhancing, but we've talked about the synergies there. What do you think you can move the gross margins up towards?
That's a very good question. Yeah, at this point, we haven't given guidance to the market of where those margins would go. Yeah, I think people are familiar with the Strix model. As Roger says, that there's certainly opportunities to improve things like working capital, and I think the mix of products can be changed quite a lot as well. So yeah, we would see opportunity to improve those margins, but yeah, I think we need to get our hands on the business and really sort of dig deeper into the business before we want to give guidance on where it could end up.
Okay, thank you. Now, you already touched on how much less you are traveling this year as to previous years. Obviously, great for your ESG creds. But in terms of keeping a full watching brief on what's happening on the ground in China, how are you managing that, and how are you mitigating any risk from not being physically present?
That is a question I get asked quite a lot, actually, and it is a really good question. We have a really good COO based over in China. He's a China national who's worked for a number of international business. We trust him 100%. I have regular meetings with him. We have monthly operations meeting over video conference calls. This business has actually always used video conferencing because of the number of different sites we have in the different time zones. So we're very familiar with that. So in truth, we haven't seen any deterioration, certainly not in the controls of the business during this pandemic. Yes, it's always nice to meet face to face, but actually I think we have been able to actually run the business very well during the process using media like this and video conferencing. Okay,
thanks. Now, you've mentioned at some point that there were further cost savings due, or opportunities, should we say, via automation. Could you quantify to what degree you expect these to impact, and when?
We've had a process whereby we've continued to put in automation lines, and I say at the moment, by the end of this year, 60% of our production lines will be automated. The process we go through for automation is we want to make sure we've got enough capacity to completely fill that automation line. And for a kettle control, that would be about 10,000 units. Sorry, 10 million units, give me the right numbers, sorry, way off there. So when we get to that sort of level, we would invest in a new site, and typically we aim to get payback on that within 12 to 18 months maximum. So that's normally the criteria we use for putting a line in place. Similar with the Aqua Optima side, as that volume increases, we'll be putting more lines in. Obviously, as we move to the new factory, we will have a lot more space. We're doubling the capacity of our existing facilities. So that does give us an opportunity to continue to invest in that automation. Typically, we're putting in something like 3 to 5 lines per year to improve our efficiencies in the business. I don't see that changing in the short to medium term.
Okay. Now, I think plenty would argue that your building of the Chinese factory has also been extremely efficient, but one gentleman is asking why it's taking so long, and he thought it should have been finished in 6 to 9 months. Now, remind us, when did you start?
Oh gosh, that is a really good question. When did we start working?
We purchased the plot of land in Q1 last year.
Yeah.
So and then we start to bid, like the bidder comes in to bid the construction of the building. And we had to obtain land permit, the construction permit approval from the government. So all in all, like the building construction is July this year plus a lockdown of a month. Is it roughly a month? Yeah. So that actually, in the big scheme of things, is not bad, because I think they did catch up to the original deadline, or not deadline, the target date of completion, which is January of next year.
It's a valid question, and actually, I often phone up Frank, our CEO in China, and say, how can they build a hospital in 9 days, and it's taken us almost 18 months to build a factory? So I do ask the same question. But to be fair, you know, there has been a lot of planning and processes that you have to go through with the local governments and so on to build that. This is a bespoke system that is being built just for us, from the ground up. It's actually really exciting to see that coming together, and it is going to give us some significant growth opportunity. Obviously, our existing factory, the lease expires in August 2021, so the opening date was linked directly with the closing of the existing facility. So timings have worked out very well, in fact.
I think so. Now, this is obviously a very COVID-related question, but what percentage of your sales are online, and what growth have you seen, particularly, I suppose, in the last few months on this front?
It really depends on the market. So in China, a significant part of the China market is online. I don't have off the top of my head a figure for the online percentage of our business. I would have to look that up, and I would hate to guess. I mean, certainly when I look at the growth rates, we've been looking at almost a doubling of the sales online during the pandemic in the various markets. So certainly has seen a very significant change. I mean, good thing is that we are still present on those platforms as well. So it is not being negative from our business point of view. And one of the positives about the internet is actually we can see all those products being sold. So you will have noticed over the last 2 years that's where we take most of our legal actions, and it's actually very easy to get unsafe kettles taken off the online platforms as well.
Yeah, okay, thank you. A couple now on cash here for you, probably, Raudres. One asking about the cash position as it stands at the moment. Was it 23 million? And is this what you're using for Laica, or if it's not, what are your plans for the cash? And the second one was around extra working capital at the year end. It looks like you're carrying an extra 10 million. If so, why is it so high, and do you expect this to persist?
Well, the first half, our liquidity pool is 23 million. We worked with the banks. We invited another bank, Bank of Ireland, to join the other 2 banks, extending the facility from 60 million to 80 million in order to finance the acquisition. In fact, if we look at it, our own liquidity, maybe we don't need to extend the financing, but just for security, I think it's just best to bring in more comfort on the headroom in order to finance the acquisition. As I mentioned earlier, for over 40 years, the Laica was managed by the owners, and so their supply chain is weak in that sense, and all they care is to them, like every piece of, for example, inventory is worth a lot, is precious to them. So they don't really turn over the inventory as much as what we watch our own inventory turns. And they don't really watch over very much about collection. All they care is that there's no bad debts. So it's very different concepts from what we usually do in the best practice of a corporate world. And so there is definitely a lot of room to improve, and a lot of initiatives that we need to build in to decrease it. So I do not have a forecast for how much it will reduce by the end of next year. Obviously, it should come down, and it will come down.
Okay, thank you. Here, the new factory, obviously it's going to increase automation, but what opportunity does it also give you for revenue expansion?
At the moment, the building itself is 5 floors, and we've effectively kitted out 4 floors. So we've still got 1 extra floor for further expansion. We are going to put in a significant number of additional lines, so gives us plenty of room for growth. As I say, the capacity of the factory is actually twice what we have today in our existing facilities. I mean, some of the things that we will be doing, we've got a number of sites in China at the moment. So we have our main factory, which obviously will move straight away. We've also got an overflow factory because our growth was too big for our existing factory. So that will automatically move into the new factory. And we've got the Halo Source acquisition based in Shanghai. and parts of that will move into the new factory in 2022 as well. So yeah, we are starting to sort of move things over, but there is still actually extra room for growth in that. And certainly as we sort of look at our long-term roadmap, we'll be looking at the right opportunities to maximise that space.
Okay, thank you. Now, obviously the USA does its usual saber rattling for tariffs with China. In terms of perhaps your major target markets, where are these, and is that saber rattling going to have an impact?
I mean, there's a number of growth opportunities. I mean, if you just talk about the Kettles, which is obviously our most significant market, we have a very, very high share globally. In the regulated sector, the US is still one of the biggest opportunities without any doubt at all. And despite that saber rattling, there's still good opportunities in the US. And I think some of the new small domestic appliances that we're bringing out may actually leapfrog the basic kettle and be more attractive. And they do like the theatre in their kitchens. They've got very large kitchens generally. So a water dispenser that provides boiling water may actually be more attractive than a kettle. So hopefully we'll sort of see some increased growth in the US from some of those products. Outside of the US, you've obviously got the mature markets like the UK, which are replacement markets. You're always very, very good. But then you've got places like India, for instance, very, very low household penetration. But it is changing. The younger generation wants that efficiency. So we are starting to see some quite rapid growth. Not quite at the tipping point yet, but it's certainly getting closer to that. So that is definitely a longer term opportunity. And Russia is another one. Actually quite a mature market, but historically been quite a copyist market. And certainly with our new products, we have very good opportunities to be able to attack that market much more aggressively, almost head to head with the copyists. So we would expect to see some quite good growth in the Russian market as well.
Okay, now obviously you used your Halo Pure technology to decontaminate your employees on the way into the factory at the beginning of the COVID crisis. Are you seeing other applications related to COVID where you are able to put that technology into use, and do you expect to be rolling out anything soon?
I mean, it's something we've looked at. I mean, obviously in China, we have approvals for that technology for drinking water. So it's very safe and it's got all the relevant approvals. So using it as a mist or anything else, is absolutely very acceptable. And the product itself is proven to kill viruses and bacteria. When you start going to some of the other territories, there are other products that actually can do those sort of things. Chlorine, for instance, is actually much easier to produce. And you can produce mists and things out of that. So we are looking at those applications, but at the moment our focus for that product range is primarily in China.
Thank you. And what about to the agricultural markets outside of China?
Yeah, again, the opportunity in China is absolutely huge. They have a policy to try and remove antibiotics from the farms. And the other technologies that exist, don't always actually provide the required reassurances. So, the Halo Pure product is ideal for that type of application. Clearly we've got a limited or a finite amount of resource, and we believe at the moment the opportunity is so big in China that that's really where we're going to focus. Could it be used elsewhere? Yes, it could. I mean, certainly we could look at applications, particularly in places like South America, for instance. Maybe some of the less developed countries as well could benefit from that. But at the moment, again, our focus for that particular product is primarily in China.
I am conscious that you have another meeting in 2 minutes, so I think we need to wrap it up there. Apologies if we haven't got round to your question. I will endeavour to get some answers out to you in due course. But just to say thank you all for joining us. Thank you to Mark and Raudres, and best of luck integrating the acquisition. And we look forward to speaking to you again in 6 months' time.
Thank you much, and thank you all for your time. Thank you.
Thank you.